Hello there. Welcome to The Close. I'm Andrew Bell in today for Morella Fernandez. The markets will be closing in just half an hour. Let's get to the big stories, though, that we're bringing you from the BNN Bloomberg newsroom. Australian mining group BHP has dropped an attempt to take over Anglo American. Bloomberg, meanwhile, says the initial offer was a mixture of cash and stock, and it was a move to disrupt Anglo's takeover of Canada's Teck Resources. Anglo and Teck Resources shareholders are set to vote on the takeover in about 2 weeks. Canada and India have agreed to resume bilateral trade talks. The announcement came this weekend after a meeting between the Prime Minister, Mr. Carney, and the Indian Prime Minister, Narendra Modi, on the sidelines of the G20 summit in South Africa. The leaders aim to reach $50 billion US in bilateral trade by 2030. The two countries exchanged about $31 billion in goods and services last year. Industry Minister Melanie Joly is headed to South Korea to meet with major Asian companies to attract large investments into Canada's defense sector. Those meetings will include talks with one of two bidders on Canada's major procurement project. Joly is also meeting with a Korean business conglomerate and heading to Tokyo afterwards. Her talks will cover the automotive industry, battery manufacturing, shipbuilding and mining sectors. Shares in Novo Nordisk under fresh pressure today. That's after the pill version of its weight loss drug Ozempic failed to slow Alzheimer's disease in patients in a pair of large studies. The company says trials to use the drug for Alzheimer's were always a long shot. The company, meanwhile, though, is struggling to regain its footing in the obesity market after losing top spot to Eli Lilly. Toronto stocks higher today in tandem with U.S. shares. Heavyweight blue chips, Loblaw and Royal Bank of Canada both hitting new records. And let's have a look at the U.S. markets. We saw Alphabet hitting a new record high, market cap closing in on $4 trillion US, as tech stocks continue to rebound from last week's selling. Let's get more on the markets. We are joined by Steve Rolls, portfolio manager at Trivest Wealth Counsel with Wellington Altus Private Counsel. Steve, great to see you. Thanks for joining us. What are you paying attention to in the market this week? What do you think is the most important thing?
Hi, Andy. Great to be here. Yeah, it's an important week. It's an important week, but a short week with U.S. Thanksgiving, and we really only have 3 days of real market, and Friday's a half day. So what we're going to see is what we're seeing today, I think, and that's just more extreme volatility stemming from last week. Today's a bit of a rebound. I think there was some good news out of Google again about Gemini 3, and that's bringing up a lot of stocks today. We're seeing the Tesla's up close to 7%. Broadcom's up over 10%. Google's up 6%. And back at home, Celestica is still moving big time today, about 13%. So the concerns of last week have sort of been pushed to the background, and we're back on the AI momentum trade again here.
Yeah, it's incredible, the turnaround. Last week, people were feeling distinctly nervous, it seemed, about massive AI spending.
Yeah, 100%. And it's one of those things, but when you really look at it, you know, if you're looking at NVIDIA, which sort of is the poster child of AI, and their results last week were so impressive. It was incredible that with $57 billion in quarterly revenue at gross profit 70% and net profit 50%. Well, they're making money. And that's what's different, is that you can issue debt if you're making money. And the cash flow services for the hyperscalers, it's very impressive. So I think if you're making cash, you're allowed to finance this capital expenditure. So to me, it's somewhat overhyped. I mean, I'm still not 1,000,000% involved in the AI momentum, but it's I do feel that last week's numbers were not really founded.
And any thoughts on the Fed? It seems more likely now we are going to get a cut next month.
Yeah, I was looking at that earlier today. It looks like 90% chance of a rate cut, where a week ago was about 40%. So it's really based on some Fed speak. But later this week we get PCE numbers coming out on Wednesday, which is the real inflation numbers that the Fed wants to look at. So that could have an influence. And really, I think this week it's primarily on the other side is the strength of the consumer. So we'll get some Black Friday numbers coming out. We'll see what that says. When tomorrow we get the retail numbers out as well. So it's continuing that contradiction between the Fed has to decide between inflation and growth of the economy. So the more data we have, the better. So stay tuned until December 10th.
The one stock you're watching, you don't own it right now in relation to AI, looping back to that, is Caterpillar. Now, we heard a few weeks ago that, sure, yeah, they do have a pretty big power business, and that's feeding into keeping AI data centers running. Investors were delighted. Is that a stock you think you might buy in the near future?
It's a resilient company, and it's done very well. I go back to my early days playing in Sandbox and was always playing with Caterpillar big dump trucks. And that's what we always think of AI as being, but really it's the turbines are really, it used to be the backup generators. Now they're the main source for AI power in a lot of the data centers. So it's incredible turnaround. And as well as we saw with the BHP and Anglo talk, that the demand for commodities, specifically copper and the electrification of the economy is really driving it too. So they're getting a win-win. And looking at the Dow Jones Industrial Average, the top performer this year to date is Caterpillar. And so it's one of these unlikely winners. I mean, they're up 52%, and NVIDIA, the poster child, is up 33% year to date. So it's these unlikely winners that, we're all impacted by AI right now. And I kind of like that theme, not necessarily Caterpillar, but some other stocks where you're able to gain from the momentum, but still remain in high quality dividend paying stocks. So it's a win-win for a lot of people. Boring, well, nothing boring about them, but an old fashioned company like Caterpillar, you wouldn't think, how would they gain from AI? Of course, we know that copper is said to be a hot commodity now because these data centers will need thousands of tons. Any thoughts on BHP apparently deciding, we're not going to take a run at Anglo American? It's hard to know exactly what happened. There was such a quick decision, and it was sort of a news headline for 24 hours, and it went to the side. I'm not sure exactly what happened there, but I think BHP is one of my holdings, and it's pays a good dividend and strong cash flow, and it's well diversified. It's if you're going to buy a commodity for a private wealth portfolio, I like to be as diversified as possible. So, but now they have the situation of, what is their play for copper? They want more copper. Now the miners tend to acquire at these type of markets instead of trying to build it out. So we'll look to see what they're doing. Are they going to continue with organic growth, or will they try to buy another miner? So it was quite a 24 hours of news there with HP.
And TC Energy, this is one you own, pipeline giant, and that stock's done well. Would you buy more at this stage?
Yeah, I'm looking at it. It's another one of these unlikely winners of AI. And if you told me 2 years ago that TC Energy would be part of the AI momentum, I'd kind of look at you a little bit different. But the demand for natural gas is going through the roof. Goldman Sachs expects another 8 billion cubic feet more demand by 2030. So who's going to supply that? Well, one of the main drivers of that is pipelines, is TC Energy right back at home here. So they've done a great job. I think the spinoff has really paid off. And used to be in the days I would hold either Enbridge or TransCanada Pipe, as it was called back then. But now they're both different companies, and I think you're fine to hold both now. They're great dividend payers, great Canadian stories, and they keep producing cash flow.
Steve, thanks very much for joining us.
Great. Thank you, Andy. Appreciate it.
Steve Rolls of Trivest Wealth Counsel with Wellington Altus Private Counsel. Up next, we are going to dig deeper into BHP walking away from a bid for Anglo American. Stick with us. So the Australian mining colossus BHP has dropped an attempt to take over Anglo American. Of course, this is part of the mating dance to take over Teck Resources. It's looking as though Anglo might have this one sewn up. Let's get more from Richard Burke of Bloomberg Intelligence. Richard, thanks for giving us the time. Start off with BHP saying, nah, we don't want to buy Anglo. Was that a surprise?
I mean, it was a surprise that they revisited the bid. We saw that, basically, if you look at the share price from the first bid back in April 2024, the share price really of Anglo has outperformed BHP. So it would, be a bigger dilution to BHP shareholders in order to get a deal done. And also the complexity of the conditions that they had last time kind of made it harder to get a deal done, so it was kind of surprised that it was revisited.
If Anglo was to buy Teck, that would essentially make it impossible for BHP to take over the merged company. It'd be just too big, for example.
I mean, that's what people are saying, that it'd be prohibitive, and the mining companies have had a history of not performing well when they made large deals. So I think, the shareholders wouldn't look favorably at kind of taking over a big conglomerate. And also then you would also have the problems that, that Anglo Teck deal is facing on, headquarters in Canada and things like that. So you would have other cultural problems that they would have to overcome that would just be bigger than they were in the past.
Yeah, as you say, Anglo Teck would be just too big and politically tangled. Have you, I mean, this is a very hard one to read, but it does sound like our federal government is pushing back on Anglo, saying we want the actual domicile moved to Canada, not just the head office.
Yes, I mean, you saw Melanie Joly came out last week with, saying that she didn't think that Anglo and Teck had done enough to maybe merit passing through the Investment Canada Act, and we'll see if there are any further conditions going forward.
You're saying that really Glencore seems to be the only potential suitor here at this stage for Anglo. But clock is ticking. They've only got about 2 weeks before the vote.
Well, Glencore, from a deal economics point, Glencore has, part of the deal, Anglo Teck deal, is the merger, the synergies between Collahuasi and QB2. The other partner in Collahuasi is Glencore. So it would make sense that Glencore would, not only see the same synergies that Anglo sees in Teck, but actually Glencore may have a few more synergies because their trading business is a bigger part of Glencore's business than Anglo's corresponding trading business. So you could see more synergies in a Glencore Teck deal than you would see in an Anglo Teck deal.
But you see any likelihood of Glencore ever moving its head office to Canada? Very unlikely. They're just embedded in Switzerland.
Yes, I mean, part of the marketing arm in Switzerland is also the trading businesses in Switzerland because of favorable tax considerations, and also we saw Glencore made a pass at Teck, and the Keevil family definitely is not amenable to deal with Glencore. So that's highly unlikely. We were just saying that from a synergy point of who could reap the most benefits from the deal, Glencore's on par with Teck, actually a little bit better than Teck, but other mining companies, not having that Collahuasi QB2 tie-up, doesn't give them the synergies that either that deal would, either of the two partners in Collahuasi would.
And of course, you're referring there to the giant mines in Chile. Richard, thank you very much. Really appreciate it. Richard Burke of Bloomberg Intelligence. Up next, the G20 summit wrapping up in South Africa. We'll discuss Canada's trade partnerships as this nation tries to diversify trade away from the US. That's ahead. The Prime Minister and Mr. Carney and India's Narendra Modi have agreed to begin talks on a new trade deal known as the Comprehensive Economic Partnership Agreement. This comes as the Indian leader, as is the case with Canada, seeks to diversify trade partnerships amid ongoing uncertainties with the US. We're joined by Sean King, Senior VP at Park Strategy. Sean, thanks very much indeed. This has got to be a tricky one, though, for the Prime Minister, because Indian state actors said to have conducted violence in Canada.
Yeah, very tricky indeed. And it was the U.S. who came to Justin Trudeau's defense, calling out India for that. I remember Jake Sullivan from the White House press room really stepping up for Canada when it mattered most at that time. And you may want to let sleeping dogs lie, because even though Trump threatened Canada with an additional 10% tariffs, because Ontario had the temerity to replay Ronald Reagan's own words from the 1980s, he hasn't actually slapped those tariffs on Canadian products yet. So this may remind him he still has to do that. So Carney, better be careful. But I totally understand where he's coming from. Canada and the U.S., we need each other. You just by sheer size, the fact that you're 10% of our population need us more than we need you. I'm not trying to be a jerk. That's just the facts. But, you're our number one export market, so we need you as well. And we're democracies with shared values and a long, peaceful border. So best case scenario, U.S. and Canada work out their stuff and we get back to normal. But in the meantime, I give Carney credit and a pass that he's got to look for whatever options he has until we settle things between Washington and Ottawa.
There's a limit to which you want to get India, obviously a democracy, China not. And he would like to improve trade relations with China, but China's a dictatorship.
Totally. And Canada learned that the hard way. I mean, when they carried out the U.S. arrest warrant on Meng Wanzhou at YVR on December 1st, 2018, Beijing responded by arresting the two Michaels and keeping them in detention, incommunicado, under a light for a year and a half. I remember that saga very vividly. I remember the whole thing with canola and everything else. And so Canada should be very careful about diversifying too much away from regimes that share its values. Now, India can be questionable with religious freedom, and Modi's a bit of a wild card, and obviously I don't like him buying Russian oil, but dealing with New Delhi is very different from dealing with Beijing. So anything Canada and India can do and get that relationship back on track, as an American who likes both countries, I'm all for it.
Yeah, there's talk now, you may have seen it, that the negotiations between Ottawa and Washington on trade are stalled. And the plan here might now be to just roll it into a comprehensive reworking of the North American Trade Pact next year.
Very likely, because it was due for review anyway. And that's another thing. We were so bewildered that Trump had so many problems with Canada because we were operating under USMCA, which was really a signature pact of his first presidency. Now, the U.S.-South Korea Free Trade Agreement, he just tweaked it a bit and decided not to scrap it. But USMCA was a serious reworking of NAFTA. In fact, a lot of people say that USMCA was really just the Canada, U.S., Mexico portion of TPP that we unfortunately left. But USMCA really was a Trump document. So I'm really surprised that he has so many problems with Canadian trade as it is today. But yeah, I think that makes the most sense right now with everything else we have going on. I heard today Trump announced, he confirmed he's going to Beijing in April, and then Xi Jinping's going to come here. We're still working out stuff with other countries. So I think the best case scenario now is hope things don't get any worse and then just do a bigger and better USMCA next year.
Why do you think Trump beat up on Canada so much? It was just seen as an easy target, or?
I don't know. He seems to definitely like the new socialist mayor of New York, Zoran Mandani. As a New York City homeowner, I guess that's good for me. But he's always had it out for Canada. He seems to have it out more for Americans' friends than our enemies sometimes. And he definitely did not like Justin Trudeau. There was just a personal animus there that I've never fully understood. I didn't agree with him on anything. I thought on China, Justin really came around. in his final few years and was happy with his policies on Asia. But Trump really seemed to have personal animus for Canada in general and Trudeau in particular. When you look back at the close relationship that Reagan had with Mulroney, probably closer now that we read a lot of declassified documents that he ever had, even with Thatcher. I just don't get it, but that's Trump.
Yeah, that's right. He does keep people guessing. What do you think will be next, though, on the trade front? Yeah, so it may go quiet. We talked about that. Carney obviously has adopted, I guess you could say, a non-confrontational approach with Trump. He dropped the digital services tax. He rescinded quite a few tariffs he'd put on or warned of in retaliation. Do you think he's handled this well with a fairly low-key response to Trump's rhetoric?
You know, maybe on exact trade tactics, he's been low-key, but you know, he did show good gamesmanship when he came to the White House, again, because he used to work for Brookfield, a former client of ours, I might add, who was saying, oh, well, you know, as a real estate guy, one real estate guy to another, and Canada is not for sale. I mean, he gave as good as he got with Trump. I think Trump respected Carney a little more because he fenced with him and bit back a bit. So maybe he's been quiet on actual trade tactics. Remember, Trump himself hasn't put on that extra 10% tariff, but I think he's given Trump as good as he gets when it comes to rhetoric and banter without going the wholly negative route of, say, Gavin Newsom, the governor of California. So now I'm not in the advice of giving foreign governments advice, but so far I think Carney's playing things just right.
Sean, I think we've less than a minute. What about this Taiwan flare-up between China and Japan? Is that going to die down? Did the Prime Minister?
No, I think it's only going to get worse. And if I were Japan, I'd be very worried about Japanese academics and or business people in mainland China being picked up as some kind of deterrent. Basically, what this comes down to in the Diet, Japan's parliament 2 weeks ago, the new Prime Minister, Takaichi, was asked about a Taiwan contingency. And she said that were there to be a flare-up over Taiwan, it would imperil Japan's own security. Yes. Considering they're next door and that a U.S. defense of Taiwan from Japan, that's pretty obvious to me. Sure. But Beijing's blown a gasket over it. They're trying to test her, but so far she's passing the test, and her popularity at home is surging because of it. She may turn out to be the great hope for Asia that South Korea President Yoon Suk-yeol was not.
Sean, thank you very much. Sean King of Park Strategies. We'll be right back. And there you have it, the closing bell action on Bay Street and Wall Street. At the NASDAQ, it's the NASDAQ Baltic Awards winners. Ringing the bell. In New York, it's Mitsubishi UFG Financial doing the honors. And at the TSX, it's the Canadian Lenders Association. You're watching the close on BNN Bloomberg. Markets rallying pretty sharply today as we move towards the end of November. That's after a pretty wicked sell-off last week. TSX, as you can see, above 30,600, not far short from the record high close of 30,827, and that was on November 12th. So the market moving up. Bitcoin has taken a pounding over the past while. We did see some strength, though, in Bitcoin or crypto-related stocks. First, let's start out with Celestica, though. Celestica, CLS, on fire today, jumping 15% with a renewed rally in the big AI stock. Celestica still down from its record highs, but what a run it's had. Wow, well over threefold in the past year, well over being a three-bagger. It's down from a record high in early November, November the 5th, of just over $512. So it has come down a bit. Let's have a look now at some of those Bitcoin stocks. We did see a rally in the biggest cryptocurrency today. Bitfarms jumping in Toronto, and Hut 8 also showing signs of life. If you want volatile stocks, they fit the bill. They tend to swing wildly. Gold was strong today, and we saw a move up in quite a few of the gold miners. And there is bullion moving up more than 1%. And the spot gold price, if I can call that up, because we're showing the February futures there. But the spot gold price now 4,132 and 4,132, down from a record high for spot on October 20th of just under 4,400. And finally, TELUS, the telecom giant, its stock hitting the lowest in at least a year. The company competes with our parent company, BCE, whose stock has also suffered. And Rogers was under pressure as well today. The yield on TELUS now around 9.2%. And Liam Gallagher, an analyst at Veritas, says that the company may come under pressure to bring down that dividend. Let's get more on some stocks on the move south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Great to see you. Investors loving Google/Alphabet today, Jeff.
Yeah, Google is just off like a rocket today, and there's a little bit of optimism surrounding its new Gemini 3 AI model. The stock is really one of the big beneficiaries, and it is up today. But one of the more kind of interesting bits to look at within the stock market so far has been the performance of those companies that would supply Google. So Broadcom is the top performing stock in the market today. It's up 11% to end the day. And it's largely just performing well because it has these connections and these ties to Google. Pardon me, I should reference the actual company, Google parent Alphabet. So we see a number of these kind of tech companies, these AI-related plays, surging again today. Of course, we had a sell-off over the last month or so, where investors had been rotating from some of those AI names into other more defensive corners of the market. Today, seeing a little bit of that reverse, and Google with its Gemini 3 AI model, a few other bits of positive news, is really the beneficiary, and its suppliers are, I suppose, even more directly beneficiaries of that mood change today.
Healthcare stocks, what's going on there?
Yeah, it's been up and down. They ended up. So what happened here today is there was initially a whole lot of optimism that in a bit of a surprise move, the White House was going to extend the Affordable Care Act, which in many circles is known as Obamacare. Mm-hmm. This was not expected. The stocks all moved higher this morning. Oscar Health ended the day over 20% higher. And for a health insurance company to move up that sharply is quite remarkable. It wasn't on its own. Molina Healthcare as well as Centene, all moving up over the course of the day. Now, there was a report that came out midway through the day that caused those gains to pair a little bit, that move might not be imminent, that there is some backlash among Congress members to extending the Affordable Care Act. Then the market seemed like it wanted to look right through that development. And as I said, the stocks did end the day higher, especially Oscar Healthcare, which is what was the final move? About 24%. Not a bad day for an insurance company.
Whoa. Bloomberg's Jeff Morgan. Thanks very much, Jeff.
Thank you.
Up next, markets in the green to start the week. We'll take another look at what's driving renewed investor optimism in AI. For more on today's market rebound, we're joined by Ross Mayfield, investment strategist at Baird. Ross, thanks very much for coming on. Amazing turnaround in AI sentiment in just a few days, it seems.
Yeah, absolutely. I mean, I think there are some specific things that help that. Obviously, Google, Gemini, and they've been a leader to the upside, even within the Mag 7 for several weeks now. But this is always going to be a volatile story. I mean, I think we're in a structural bull market driven by AI and AI companies. And so even if the volatility ramps up, even if there's more DeepSeek moment down the road, I think there's going to be enough people who want to buy the dip when these stocks get even relatively cheap. And it's not been much of a dip this time, about 5% of the S&P, but a bigger pull down in some of these tech and AI related names. And I think there's just a structural floor because I think there's enough people who want to own these companies.
Yeah, it's quite the rally in the Nasdaq as well. These concerns, though, won't go away, will they? The massive hundreds of billions of dollars in planned spending. We really don't know whether there'll actually be the corporate profits ultimately to justify that.
Yeah, absolutely. I mean, and that's why, to me, the NVIDIA results last week, you had the big pop, and then the market completely reversed that Thursday after the results, because the NVIDIA results don't answer the fundamental question, right? The question is not whether there's demand for NVIDIA's chips or whether there's demand to build out the infrastructure. The question comes downstream. Is there a return on the investment that the hyperscalers and a lot of these other companies are putting into the ground? And particularly now that there's a little bit more debt financing, some special purpose vehicles, off balance sheet stuff. That's the type of thing where investors really start to get nervous. So it's not just, is this a good investment by these companies if they're spending out of their cash hoard or their free cash flow, but especially now that they're tapping debt markets and getting a little more creative with the financing. So that big question is still lingering. And I think it's going to just create volatility in these stocks until we get some sort of answer. Is there a killer app? Is there a model that really just takes things up a level?
What way are you playing this? Are you overweight the Mag 7? Are you market weight, which obviously would force you to hold a lot of these equities?
Yeah, you can have plenty of AI exposure without being overweight. I mean, the Mag 7 itself, I do think it's worth breaking those into their component parts. I mean, there's the seller of the chips, there's the hyperscalers, and then Tesla, I think, kind of is idiosyncratic, given its attachment to the more cyclical auto sector. So I do think you can buy semiconductors. I think buying the dips in these companies when we have the inevitable volatility or the inevitable questions about the ROI, I think there is going to be a good path to profitability there. And then the question about profitability more broadly, I think it's a fair question. But if we just look at this third quarter earnings season, not only is the Mag 7 and the tech sector extremely profitable, high margins, but the other 493 companies in the S&P 500 are printing double-digit earnings growth year on year. So very strong corporate fundamental backdrop against this AI question, which I think helps sentiment and kind of keep a floor under the market during these pullbacks.
What about the U.S. economy and the Fed? I mean, it looks as though the Fed is now, or market watchers and interest rate players think the Fed is sufficiently concerned to cut rates again next month.
Yeah, I mean, I think they should. It's not like we've gotten a lot of data that would have changed their mind over the last month or so. Mm-hmm. We've had this wild swing in Fed fund futures odds for rate cuts, and those have shifted back towards a cut in recent days after a couple of prominent Fed speakers have come out and called for a cut. Look, I think they're mildly restrictive. They're above what they believe the long-term neutral rate is. And we have a labor market that's clearly slowing. I think there's plenty of argument to be had about how weak the labor market is, but there's no real upside impulse from inflation. The tariffs have not proved inflationary yet. You have this working paper from the San Francisco Fed that says, the history of tariffs is that they're deflationary. So you have a weakening labor market and no real upside from inflation. You've got rates in restrictive territory. I think it makes sense to get to neutral with some haste and then reevaluate the landscape. And to me, that all comes together for why wouldn't you cut 25 basis points in December and start 2026, fresh. So that's where I landed. I think the Fed is shifting that way too. I'm not sure what, we've been in a data vacuum, so I'm not really sure where the big shift has come from anyway.
You reckon that American investors are chronically or on a large scale underexposed to global stocks?
Yes. The data bears it out. And then anecdotally, just talking to clients, it had been such a rough decade plus for international versus the U.S., a period of perpetual dollar strength. The U.S. economy, outperforming the tech sector concentration in the U.S., leading to outperformance. And I think that many American investors just threw in the towel in international. And I would say that right now is a good time to revisit the case for international for diversification purposes, to position for a potentially structurally weaker dollar over the next cycle. And because that tech concentration cuts both ways, and international stocks have been outperforming this year. and with less tech exposure. So I think it's a kind of a perfect barbell strategy. I think it's a very good time for American investors to revisit international. And they're cheaper too. They've been cheaper for a long time, but there's finally some momentum there. And that's usually the kind of thing you need to see to get valuations to move higher.
Thanks very much indeed, Ross.
Thank you.
Ross Mayfield, investment strategist at Baird. Coming up, Morningstar's predictions for the markets in 2026. Stick with us. So nobody can predict what 2026 will bring, but some themes are emerging on a consistent basis, such as tariff tensions and high valuations in the AI sector. Some investors, of course, are nervous. Morningstar has come out with an outlook for next year, and we heard from one of the authors, Philip Strail, Chief Investment Officer, covering the Americas at Morningstar Investment Management.
One of the things that is still an uncertainty at this point is the potential decision by the Supreme Court in the United States, potentially in December or January, with an announcement around their decision as to whether some parts of the tariff framework, whether that will be shut down. I think that will create some volatility. So as we look into 2026, we don't expect the April level, volatility, but certainly still uncertainty around there with the tariffs in 2026.
What kind of a twist would a ruling have that some of those tariffs were unenforceable? They'd have to pay money back. That could make for a bit of a nightmare for businesses.
Yeah, I would say actually the biggest trading partners, our expectation would be that those tariffs will just be shifted in terms of the legal statute. So there's probably not a huge impact. Some of the smaller trading partners, it might actually be a relief, but it will just create uncertainty in the market where markets will be wondering which sectors might be impacted. But by and large, we would not expect the same type of downside risk as we've seen in April of 2025.
And geopolitically, I mean, we're hearing possible talk of a peace deal between Russia and Ukraine. No guarantees, of course, with everything the way it's unfolded there. But I mean, there is talk of that. What kind of an impact would something like that? And are there any other geopolitical aspects that you're keeping an eye on?
Yeah, the Ukraine-Russia deal obviously would be significant in terms of the impact from a humanitarian standpoint. We'd say energy prices, oil markets would likely be most impacted by that. We've seen some downward pressure on oil, as you've pointed out this morning. And so it's mainly on the energy side, we would think, as far as, kind of the market implications, but obviously a very important deal as well. The second element would be defense companies, which have done very well this year, especially in Europe. And so a potential deal there would put potential downside pressure on defense stocks if that were to come to fruition.
And of course, the thing that everybody's talking about, AI, what's next for it? We had some pretty good earnings for the most part, still some nervous investors out there. Is that going to change, do you think?
AI has been the dominant theme for the past 2.5 years, really off of the low in April. That really was what reassured markets, and a lot of these AI stocks, NVIDIA, did very well off that low in April. But we think that there's probably been a level of frothiness and very elevated expectations that have been baked into some of those valuations, and we've seen a bit of a pullback in these stocks in recent weeks on the back of even beating earnings. And so at this point, it's probably more of a sentiment shift. But going into 2026, big question is whether those companies will stick to the CapEx plans that they've announced, so far this year.
And they've been aggressive with that. Is that what's making most investors nervous then?
I think it's part of it. I think there's a technical element, as I mentioned, where I think the market's gotten somewhat narrow, especially in the September-October period. And in recent weeks, we've seen a bit of an unwind there. But if we were to see a pullback on the CapEx guidance by the large hyperscalers, I think that could lead to more significant downside. So our view would be for investors to try to diversify away from some of those large cap names and find opportunities perhaps in higher quality healthcare and consumer businesses, for example.
And yeah, healthcare's it's had a nice bounce back lately, and you still think there's some deals to be had, though?
We think so. Yeah, we think it's underperformed the S&P 500 for the third consecutive calendar year. It's kind of lagged the S&P by about 70% over that time frame, and so we still think that there's value. It's has better earnings growth than the overall market, and we still think that there's room for some of that regulatory overhang to ultimately boost some of those stocks.
And outside North America, what are some of the things you're looking at?
We still like non-U.S. stocks from our perspective, especially if you are, from a Canadian or from a U.S. investor standpoint, given valuations, also from a currency perspective. We like Latin America as one of the areas. For example, in emerging markets, it's trading at Brazil, for example, is trading at 11 times earnings, and that's much more attractive than, let's say, the S&P 500. That's closer to 23 times earnings.
And also, you mentioned in some of your notes here, talk about the UK as well as an interest to you.
Yeah, the UK is, despite its, kind of economy that is, there's obviously different things going on with the budget there, but access to a lot of high-quality global businesses. And if you look at that market from a valuation standpoint, we can still see a lot of value in those businesses. And so, given the strong rally we've seen in many parts of equity markets, we think the UK is an attractive area to be as well.
And just one, we're almost out of time, but just quickly about South Africa as well. You're calling it a hidden gem.
Yeah, South Africa is one of the markets that we like, and we think from a commodity cycle standpoint, and given some of the pressures we've seen on the commodity side of things, that's an area that we like. It's an early story, and we might see some volatility there, especially if we talked about the geopolitical dimension, but it is one of the areas that we like as well within the emerging markets.
Coming up, Citi took a look at the impact of artificial intelligence on the finance industry. We'll be right back. Trade talks between Canada and the US are still on pause, but planning is underway for the Prime Minister to attend the 2026 World Cup draw on December 5th. So there might be an opening for the two leaders to meet again. Let's get more from Bloomberg's Derek Duclos. Derek, I think I'm right in saying that December 5th in Washington, the World Cup draw?
That's right. It's the World Cup draw. It is at the Kennedy Center, which, of course, President Trump overturned the board of that as one of his many moves since he became a president. I believe he's the chair of the Kennedy Center board, and so that's where they are doing the draw. And, it'll be a big event for soccer fans, but it's hard for the president to tell the Prime Minister that he can't come because, of course, Canada is one of the three countries hosting this big event next year, along with Mexico. So whether or not this actually leads to any trade talks, I mean, that's a matter of speculation. In fact, it's not even 100% certain at this point that Carney is going to go to Washington, just that they're making some plans that he might go. And that would, of course, put him in the same room as Trump, really for the first time in a month.
Right. In Canada, of course, assured of a berth at the World Cup. Ireland, we're going to have to wait till March, in case you were wondering if the Irish would make it. You guys reporting today, you've been talking to government sources, and the feeling seems to be that there might not be any more significant talks until the full workout of the North American Trade Pact next year.
Well, yeah, I mean, it's inherently hard to predict the future. But one thing we can say for sure is that there's really been nothing happening in the past month. October 23rd was the day where President Trump, late at night, did that angry social media post where he expressed his frustration with Doug Ford's anti-tariffs ad and said the talks are off. And then 2 days later, He said, well, we're going to put an extra tariff on Canada, an extra 10%, which hasn't happened yet.
Right.
And we don't know whether it will. But this is the first time really since the Canadian election in April that we've had a whole month without any sort of serious talks or any talks about talks. So it seems like a lot of the most difficult stuff, particularly around sectors like automotive, that's super complex, that's more likely to wait until the review next year, which means the current tariffs likely stay, at least for the short term.
Yeah, it's interesting how that file has gone quiet. Derek, we better leave it there. Thank you very much indeed. Derek Duclos of Bloomberg. Citi is out with a report on how so-called agentic AI could affect the finance industry. According to this research, AI and its agentic version may have a bigger impact on the economy than finance, than even the advent of the internet era. We heard from one of the authors of that report, Sophia Bantanidis, future of finance analyst at Citi. We kick things off with her thoughts on the difference between AI and agentic AI.
Agentic AI is generative AI plus action. Agentic AI is the do-it-for-me technology. It sets a goal, it plans a task, it takes action, and it adapts to feedback. This is very interesting in the financial services space. Let me give you an example in the payments area. It can take steps to resolve a problem or an issue with a payment where there has been a payment error. An agent can go through an autonomous workflow. It can go through your unstructured data, cross-check things, confirm where the mistake has been made, amend the payment mistake, submit it for approval, and log it in the audit trail. That's agentic AI. It builds on generative AI. And because we have generative AI, we are able to have agentic AI. Generative AI is the create-it-for-me technology, agentic being the do-it-for-me technology. Of course, AI as a branch, as the umbrella term, we have had for years in financial services. We've had machine learning AI, traditional AI, since I believe it is 1956. That type of technology works very well on structured data. But most data we have in financial services is unstructured. And that's why generative AI and its sister or cousin, Gen AI plus action, agentic AI, is very interesting for financial services. And that's why we wrote a big report about it. Agentic AI, finance, and the do-it-for-me economy, publicly available.
Now, you had a quote from Ren Ito, the co-founder and CEO of Sakana AI, and said this year, 2025, will be a wow year for agentic AI in finance, similar to the year 2023 for being a wow year for Gen AI and 2024 for large language models. Has it been then, in your eyes? Has it been a wow year, 2025?
Yeah. Look, I think it has been a wow year. We say in our report, we quote Ren Ito, like you said, we quote many others. We say 2025 is the year of agentic AI. I think so, because it is the moment where different pieces of the puzzle came together. Number one, the models, the LLMs. Number two, the cloud infrastructure. We've seen the big hyperscalers. I'm not going to name any names. We all know who they are, but they have gone all in on agents, right? They have shipped the tools for us to use. So we got the models, we got the cloud infrastructure, and we have the enterprise controls and guardrails. We are starting to move past demos and prototypes and into some use cases. Yes, we're only still scratching the surface, but we are starting to move in that direction. And when I look back on the year for myself personally, I speak at conferences, financial services, FinTech, Future of Money conferences around the world, from Mobile World Congress to more recently, Money 2020 in Vegas. When you look at the agenda and where the conversation is, everyone is talking about agentic AI and doing something with it. There has been an awful lot of money as well that's been poured into this space. We talk about that in our report. We're starting to see these shifts from pilots to production, and that is why I think 2025 was the year of agentic AI, and next year will be even more exciting.
And so how do you see it being implemented for 2026? And then beyond that, And what kind of an impact does this have, I mean, on careers, on people who work in the industry? Are we going to see mass layoffs, do you think?
Yes, okay. That's an awful lot of questions.
That's a lot of questions. Sorry, I'll stop now.
Right, let me take it in turns. I think the first question you said is what I think will happen as we look at the year ahead, right?
Yes.
I think 2026, we will see more deployment, okay? Potentially the year of scale deployment, something like that. So that's one thing. I think what we will also see is measurable commercial impact. By that, what I mean is we're going to start to hear about the first return on investment stories. That's my personal view. Because as we know, we have a shift with AI from, wow, this technology is so cool, to how are we implementing it, to ROI, right? Return on investment.
Yeah.
And there's a time lag for all of these things, okay? The next thing that I think we will see is the conversation will shift towards agentic commerce. What I mean by that is when agents start transacting on your behalf, they will show you options, but they can also act for you in financial services. They can compare financial services products. They can potentially move your funds around to find the best savings product or to renew your mortgage. This idea of agentic commerce, which will be a real game changer when a bank's clients like you or me start using AI on our banks. So that's what I think is going to happen next year in terms of sort of agentic AI and where the conversation is going. Then I think you also asked me about the jobs question, right?
Yes.
Are we all going to lose our jobs? And, you know, this is what I love and hate about AI is it creates such polarizing views and discussions, particularly around the jobs point. It is a point we have addressed in our report. The short answer is yes, tasks are going to change. The tasks we do as part of our jobs are going to change because of this technology. The implication of this technology and generative AI is that productivity is going to rise. We're all going to be more productive. And therefore, we will shift towards higher value activities and higher value tasks, be that tasks that require oversight, tasks that require judgment, tasks that require a certain type of client engagement or handling exceptions in financial services or strategic work. What we also say is that some repetitive operational roles, some that you would traditionally outsource, those may shrink over time. Yes, that is also true. But new categories of work and new jobs will emerge, things that we perhaps hadn't imagined in the past. Examples of these new types of jobs are those who will supervise the agents, your agentic AI ethics officer, your agentic AI guardrails officer. Now, they might be called something else. The person who designs the workflows, the one who manages data quality, the person who enforces governance. All of these are examples. So agentic AI doesn't replace the workforce, it reshapes it. And that's why I think it's important that we are all curious, that we adopt to technology. It will not just change the way we work, but also the way we live and the way we enjoy our lives, the way we play as well.
And moving on to with using agentic AI, I mean, there's a concern with ChatGPT, things like that, that you have to be careful about what kind of answers you get because it's the sources. How will we know anything involving agentic AI is accurate? How do we learn to trust it?
How do you learn to trust it? Okay, here you are talking about the hallucinations that we are seeing with generative AI. I think you have to put in place very similar guardrails and governance frameworks, such as the ones that firms have been putting in place with generative AI already. And we are already seeing in some parts of the world take certain approaches to regulating the application of AI. look at what Europe is doing and the framework it is putting in place, and look at what's coming out of the other standard setting bodies. They already give you very good ideas in terms of what kind of questions you can expect from regulators and policymakers when they come to scrutinize your AI frameworks.
Sophia Bantanidis, future finance analyst at Citi. Up next, we are going to have a sit down with MSCI's Chairman and Chief Executive Officer, Henry Fernandez. He'll talk about trends he's seeing among Canadian investors and the impact of AI on the global financial landscape. MSCI, of course, a major global provider of investing benchmarks. We'll be right back. MSCI creates indexes, risk management products, and analytics for asset managers in both public and private markets. And at the end of last year, more than $16 trillion US globally was tied to various products, including indexes calculated by MSCI. So it's a major player in setting investment standards and benchmarks. We're joined by the Chairman and Chief Executive Officer, Henry Fernandez. Henry, thanks very much indeed for joining us.
Thanks for having me.
Just give us an idea. Where do you make most of your money at MSCI? I know you're very diversified, but what are your main businesses?
So the company as a whole is, as you describe it, an investment tools or investment infrastructure company that serves about 8,000 investment institutional clients in about 100 countries. The product that we're well known for are equity indices that measure the performance of markets. So that's about little over half of the revenues of the company. Another quarter comes from our risk management and performance platform. Another, say, 10%, 12% come from ESG and climate, and the balance from private assets.
And it's a fascinating story. You, I believe, took the company public about 18 years ago at a much lower stock price. Just give us a bit of history of MSCI.
Yeah, so I created the company about 30 years ago inside Morgan Stanley with two shareholders, the Capital Group of Los Angeles and Morgan Stanley, with a view to create a diversified, comprehensive investment tools company for the institutional market. So we were private inside Morgan Stanley and the Capital Group until about 17, 18 years ago. And then we separated from Morgan Stanley and the Capital Group in 2007 and took the company public, and it has been independent and public ever since.
Just looking at the stock price, over the past couple of years, it's been fairly flat. Now, I understand this is a malaise affecting data software companies, generally people uncertain about the effect of AI. Why is that, though? I mean, the shares haven't done much since 2024.
They haven't indeed, and I'm not too happy. As the largest individual investor in the company, I'm not too happy with that either. And a lot of it has been that the active asset management industry, which represents about a little less than 40% of our total revenues, has continued to be an industry under significant pressure in terms of outflows, high cost structure, and consolidation. And the second headwind for us has been the ESG business. We clearly were a big beneficiary of that. But I think we are now taking major steps on reviving growth and hopefully share price by expanding into private assets, expanding into more index investing, and expanding into other client types, such as wealth managers, banks, insurance, GPs, and the like. So we're very hopeful and very optimistic that we're going to get back on a high growth. We've always been high growth, but on a higher growth path and hopefully the share price will recover.
I want to hear about your new businesses in a second, but I'm just dead curious. The rise of ETFs must have been great for you because an ETF needs a benchmark. What are we going to put in the darn portfolio?
Yeah, so that is, we can talk about the headwinds, but for sure, one of the major tailwinds has been index investing, especially ETFs, but also institutional passive investing or index investing. That grew about 17% year over year in the last quarter. And we now have almost $6.5 trillion our clients have $6.5 trillion in index investing directly linked to MSCI indices. So that has been a major tailwind for us, and it's been the part of the company that has been growing pretty fast.
You said this is very interesting. You talked about moving into the private equity area. I guess that's tricky, isn't it? Because by definition, these things aren't publicly posted every day. But there must be an urgent need for benchmarks in private investing too.
Yeah. So if you are a global asset allocator, such as the Canadian pension funds, for example, they end up investing in public assets because they have transparency and liquidity. And likewise, they don't as much on the private assets because of the same, they lack transparency and liquidity. MSCI is out to change all of that. We are already providing major product lines to shed light into the transparency of all these funds. And over time, we're going to help with liquidity, not because we're going to be market makers, but because we'll be able to derive and supply valuations of the underlying holdings of these public assets, I should say these private asset class funds, so that people can create bigger secondary markets on them. So that's a big area of expansion for us.
We're very tight for time. Just tell us, are you seeing any trends among Canadian investors right now or anything interesting in the Canadian market?
For sure, the biggest trend is what the Canadian pension funds call the total portfolio approach, which is a really next evolution of investing. Instead of focusing on individual asset classes only, focus on the entire portfolio and how you can allocate assets across the portfolio more seamless and more rapidly. And we are creating products for them.
That's an interesting area. Thank you very much for giving us your time today.
Thanks for having me again.
Henry Fernandez, Chairman and Chief Executive Officer at MSCI Incorporated. Coming up, Hot Picks, we zeroed in on 3 industrial stocks that could be winners in the AI build-out. On Hot Picks, we zeroed in on 3 industrial stocks. We were joined by Martin Toner, Director of Institutional Research, Growth and Innovation at ATB Capital. We kicked things off with his thoughts on the question of, is there an AI bubble, and how might that affect his recommendations?
All great growth stocks climb a perpetual wall of worry. It's no different in this space. I mean, the AI space has materially outperformed this year. Outpacing most of my coverage universe, including some of the SaaS stocks I cover, as growth investors have been finding better growth in AI than other spaces. Now, that trade's come in a lot. NVIDIA's down about 15%. The Bitcoin miner ETF is down around 40%. Now, that ETF has become a high beta AI play because those companies are currently becoming data center providers for AI. I mean, the bears have become pretty loud, and they question the GPU rental rates, the useful life of a GPU, the circular financing, if and how and who will finance the significant capex required, and how can the industry possibly get an adequate return on the massive $5 trillion investment in capex that we expect to go in. The ATB view is that currently, amongst hyperscalers and neoclouds, most GPUs, even old ones, are currently sold out. an older GPU, say a H100 that's 2 or 3 years old, might rent at a lower rate than some of the bleeding edge GPUs, but regardless, they're still sold out.
Okay.
In fact, some AI is currently being done on CPUs. So back when Microsoft reported, the CEO said that if they were not capacity constrained, they would have grown faster. So that, to me, that implies that the returns they're getting on their existing investments on AI are pretty high. I mean, the question is, can that persist? And we think it can.
Okay,
and we think these. Go ahead.
Oh, sorry. I want to jump in because I want to get into the stocks you want to talk about. We're getting tight for time. So, TeraWulf, it's long-term data center contracts that are attractive to you.
Yeah, so they're an infrastructure provider that's currently building out more than 1 gigawatt of capacity. They currently have 3 contracts with 2 customers and a very large guarantee of those contracts from Google. When I look at what this company is going to be in a couple of years, based on them delivering on time, they'll have about $1 billion of EBITDA in 2027. And the stock's currently trading at, if you include all of their debt, 7 or 8 times that amount. If you look at traditional data center providers, they trade at up to 3x that amount. So we think with continued execution and more growth, this stock represents a pretty interesting opportunity.
Okay, and I want to get the other 2 in as well. Bitfarm, it's down 60%
Absolutely.
From October.
Yeah. I mean, you look at the stock, it looks a little crazy. One thing to keep in mind, so they're sort of a fast follower in this space. They're a year or a year and a half behind TeraWulf, but since the lows earlier this year, they've significantly de-risked the balance sheet. They now have roughly $1 billion in liquidity. Stock has an market cap of about $1.5 billion, and they have a lot of capacity, more than 1.5 gigawatts. So as they build out this infrastructure, stock currently trades at an EV of less than $1 million a megawatt. And based on our analysis of existing deals, the opportunity of a deal is to increase value to up to $8 million a megawatt. So there's plenty of opportunity in this stock, and it's sort of the highest beta of all of these names. So if you're a believer in this space, that's an interesting one to take a look at.
Okay, and the last one, we got about a minute or so. Galaxy Digital.
Yeah, Galaxy Digital, a company we've covered for a while and really like. They're sort of 2 companies in one. One is an AI infrastructure player, a little bit like TeraWulf. They have contracts for 800 megawatts of capacity that they're building out over the next couple of years, and they have potential to grow that significantly. And then the other side of the house is a broker for institutions that are trading and investing in digital assets like Ethereum, Bitcoin, Solana, and other cryptocurrencies. Now, the stock is priced for, we think both of these businesses are worth about $30 a share. The stock's currently $20 a share US. So we think there's a lot of opportunity here. I'm not too sure what investors are paying for in the current stock price, given that these 2 trades are they've been fairly correlated. Like if you take a look at price of Bitcoin and compare it to some of the AI stocks, it's fairly correlated. So both things have been moving in the same direction, but we think that this dip is a nice opportunity to buy a high-quality company with a great growth rate.
Martin Toner of ATB Capital Markets, thank you very much indeed for watching today's program. Have a great evening.